A big hello and a very warm welcome to our culminating episode in the special series HSBC Mutual Fund presents Informed Investing Season 2 partnered by ET Now. In the series, we have covered it all from changing mindsets around mutual funds to the best strategies for unlocking investor potential. And to conclude the series, I am in an exclusive conversation with one of the most respected thought leaders and trailblazers in the space, the CEO of HSBC Mutual Fund, Kailash Kulkarni. Kailash, thank you so much for joining us. And
thank you.
As always, it's a pleasure. And it has actually been a very interesting journey partnering with you in this series. But I will start with the data point, and I know you are the data person. So in June, actually, 2025, the AUM for the industry almost touched 75 lakh crore. Now, obviously, we have seen the kind of revolution that's taking place in the mutual fund industry in India. Can we confidently say that the mindset of investor in India, one, it has matured, and second, it has moved from capital preservation to capital optimization?
So I'll give 100% thumbs up on that. I think majority of the investors today are coming in with a longer term plan, a longer term view. It's no more just chasing the last 1 year or 3 year returns. They want to understand how they can make their life better. They want to understand how they need to plan better. So while they have been doing this in the past, they know that it was unstructured. So there's a lot more maturity which has come up, and technology has really helped. So while clients do come with doing their homework through technology, but they are willing to listen to good advice, good people to guide them, and they are taking that stance. Maybe that may not be so prevalent today with the under 25 generation, who are more shorter term and more short term goal oriented in nature. But I think things are changing dramatically for the better. And I completely agree with you, it's more capital optimization. How can your money make more money rather than just chasing returns?
Right. But at the same time, I think some of the dynamics which might have changed are also the priority of especially the younger generation, which is investing, let's say, in mutual funds or equities now?
Yes and no. So while everybody likes to make a quick buck, even SEBI put out that data that 90% of the people actually have lost money in F&O.
Yeah.
And for 4 years now, they're putting out that data. So it's not changed. That percentage has been 89, 90, 91. So I think what people realize that it's not easy to make quick money. There is a science towards it. There's a discipline which is required. So people do try. Then when their fingers get burnt, they realize, no, it's not that simple. And hence they come to somebody and seek advice. I think one big change that has happened by dealing with, say, a 35-year-old plus person versus somebody who is sub 30, is that you need to factor in a lifestyle expense also for the younger generation. Earlier it was very simple, your income minus your fixed expenses for running your house, some discretionary expenses for maybe some dinners outside or some cinema, etc. And out of the balance money, how much can you spare for investment? But now apart from that, there's something called lifestyle expenses, because the younger generation likes to travel, do these exotic holidays or do some crazy things like, 3 days of going to some island and just being there. Now those are things which you cannot tell them that no, you do this after the age of 45. They will not even listen to you.
Right.
So it's a way of packaging it so that they understand that yes, even these goals can be achieved, and they are seeing you talk to them in their language. So you need to be much more shorter in terms of your communication time, because they don't have the patience. So you can't spend 2 hours with them. You need to say the same thing in 20 minutes. They're willing to listen. So I think things are changing. But one thing, whether you're 20, 30 or 40 or 50, remains the same, that you want to ensure that you can make enough money to enjoy life.
Right. I want to touch upon, the India growth story. Obviously, India is the fastest growing and best performing large economy in the world. And the Indian corporates are also growing. Now, in developed markets, what we have observed is that they are very open to investing almost up to 20-25% of their corporate treasury in mutual funds and ETFs. In India, there is a struggle on that front. One is, how can that trend change? How do you see it changing? And second is, what are you doing, especially at HSBC, to enable that?
So yes, right now this phenomena is more prevalent with the larger corporates who are there, who have substantial treasury surpluses, where they really utilize their money from one day to maybe 2-3 years of horizon of investment, and they do deploy it into fixed income markets, or also some part of it into equity markets also. I think two significant changes have happened, and one has actually been led by the government. So when the government of India gave the permission for EPFO to go 15% in equity,
Yeah.
right, from virtually 0 then to 5% and then increased it to 15%, I think that signaled a big change for people, saying that, oh, if the government is saying in a product where you're kind of giving a confirmed return or so, you are now willing to say that 15% of your money going in equity is not so bad because your economy is doing well and it should actually give you that additional return. I think that gives great confidence to lot of corporates which are government oriented corporates. So it could be a public sector undertaking, or it could be somebody who's having a large percentage share owned by a state government or central government. Those corporates which are not even touching liquid funds and stuff like that have started looking at these kind of treasuries. Second is, and this is a very opportune time, luckily you have asked me that question, there is a body under CII which is for the emerging businesses. So these are the SMEs more, not even the MSMEs, it's the SMEs, and these are people who are typically under the age of 40 who are running these companies and who want to grow and become larger. They want to come into scale, they want to list their company. So there was a 3-day seminar held in Bombay, and I was actually invited along with one of my other colleagues from the industry to talk about how their business money can make more money. So it wasn't on equity, right? So more such things need to be done. Can every company, every corporate start thinking about deploying their surpluses into short-term instruments to make that additional money? And I think given the nature of today's work, where not just top line is important, but controlling the expense is also important, they realize that such proper management of money in treasury management instruments can actually help them save, say, 1 month electricity cost, or 2 people's salaries can be taken care of. So more people are now veering that way, but we have a long way to go. What can we as an industry do, and what can we as HSBC do? We need to engage a lot more with these corporates, have these small conferences, tell them the power of how easy it is to invest, and how when you redeem, because the issue they are not worried about is what return they make. They are more worried about when does the money hit my account. And so long as you can keep the cutoff times in mind, your money typically hits your account by 9:30 in the morning when you are starting your office. So I think these are the big changes people want to learn more, and we are doing a lot of these in kind of small meets across tier 2, tier 3 cities with the local industry bodies also.
Right. Kailash, you have been very closely operating in this industry and have been part of various investor education initiative. Now, actually we both. India is a unique melting pot. You have one set of investors who are still entering afresh in the world of investing, and they still have to some extent a traditional mindset. Then you also have a middle layer which is very disciplined and probably doing SIPs, and then you have a layer which is very evolved. So to that extent, it's a very unique market to operate in. In your opinion, this traditional belief that gold is a safe haven, or we should look at some sort of asset which can be liquidated anytime if required, has that mindset really changed, or are people still considering an instrument like gold or probably real estate a very solid investment option?
So I think for gold, the mindset to change, I think, may take another decade. Okay, very honestly, especially how the way the gold has run up in the last 2 years, right? So I don't think gold is something where the mindset has changed, but real estate, there's a very clear indication of mindset change. People act. So I'll tell you what happened. COVID, I think, was a big turning point. Okay. What was required in COVID? Businesses shut, shops shut. So your income literally shut.
Correct.
The only thing that possibly gave you money at the end of the day were your liquid instruments. So if you put a redemption in a mutual fund, you got your money in T+3 those days in equity, or in fixed income, you got your money in T+1. So suddenly liquidity as a function which hardly anybody looked at in the past started having a premium. Okay? And post-COVID, what we have seen is they've realized that real estate is not so easily liquidable. So you can't sell it and get money. Sometimes it gets stuck for more than a year.
Correct.
Plus all the headaches of doing the paperwork, transferring it, etc., etc. And that is something which we have clearly seen a big shift, saying those who had those 2 houses, 3 houses, 4 houses want to liquidate one and put their money into mutual fund. That trend we are seeing very clearly. Second trend is that earlier if you had a lot of money you would want to buy another house. That's not happening now, because people have realized that maintaining the house, managing the house, all that takes a lot of effort and trouble. While capital appreciation may be there, may not be there, in some cities it is there, in some it is not there. There are enough anecdotal evidences which have said that no, not all cities give returns on real estate, what used to be in the past.
Correct.
And to that extent, if I have to declassify that, gold still will take time, but real estate we have started to see the change.
One of the feedback that we often come across, especially in investors who are probably not so well aware of the nuances of the mutual fund investing, they often get confused between, let's say, different types or different categories of fund, then the tax impact, probably the long-term gains tax, short-term this, that. So it becomes slightly confusing. Now, what can be done to actually make them more aware, or maybe make their, I would say, investing easier, the ease of investing, especially in mutual fund industry? What is your view on that?
So I agree with you 100% that it's a very complex world because you have 3,000 schemes which to choose from, short-term, long-term calculate, debt taxation changes, equity taxation changes. Now there's a new category called income plus arbitrage fund which has come about due to the tax laws which are there. It is complicated. So I'm not going to shy away from it and say that no, it's not complicated. I think two things the industry needs to do. We need to de-jargonize a lot. Somewhere unfortunately, our habitually we tend to use a lot of jargon. So we need to keep the language very simple, number one. Second is for the retail. May not be for the mass affluent or the affluent, but for the retail, can we go more vernacular? So, we can't be an English-speaking industry. Today, we have seen many mutual funds, for example, including ours, we have literature in 5 languages at least. But is 5 enough? Why not 15? Can we explain terms rather than talk of only ratios? Yeah? I mean, very honestly, at a retail end, PE may not necessarily be understood, right? So can we talk to them in simpler ways by giving some simpler example? I think to a large extent we have started moving in that direction. Are we in a scale of 1 to 10? We are still on the lower end of the band. We need to be at least 7, if nothing else. So there is a lot of work to be done in this area. But taxation, I think that is where, so when you have 10, 15, 20,000 rupees, very honestly, you don't really bother too much, because now with 12 lakh rupees as your tax exempt limit, people are not so concerned also, and long term, short term, they do it on their own.
Correct.
But the moment you have some 20 lakh, 25 lakh, I think that's when people start realizing, oh, I need some professional help to help manage this. So the other thing the industry needs to do, from the current 150,000, 200,000, depending on what number you take, number of advisors available or distributors available to talk about this, can we scale this up significantly? I think there again we are seeing a lot of change. More people want to join this industry, because unlike 7 years ago, when people didn't believe that this is a profession which you can make your living on. Now there are enough success stories to say, oh, you can make a comfortable living if you are into this business.
Correct.
So now this is being treated as a profession. Not like a agentaya, you know, earlier how it used to be said. It's actually been taken as a serious profession. And the best news, you know, Mihir, that I'm actually seeing a lot of second generation wanting to join their parents, which was not the case 5, 7, 8 years back.
Right.
They want to join because they know that here you can make serious money for themselves. So I think that is the big change which is there.
Right. There's one more, because you mentioned COVID, I also wanted to understand that is there a noticeable change in the way people invest post-COVID, especially this, you know, there was this belief, especially pre-COVID, that men used to take or males used to take most of the decisions when it comes to investing, which instruments to look at, direct equity, mutual fund, this, that. Actually, we felt that that might have changed post-COVID a lot. What is your observation?
So yes, there's been a significant difference pre-COVID and post-COVID. I think first thing I would say, whether it was a male or a female, obviously it was dominated by male at that point of men. Return chase of 1 year was, I think, the primary objective of getting into the scheme or the fund. So net you accumulated a lot of schemes or funds over a period of time, because every year the best 3 would be different. So you would keep investing in the best 3 and then have 15, 20, 25 schemes, you know, in your portfolio, which is not the right way to go about.
Right.
Post COVID, 2 things have happened. They've realized not all schemes perform at the same level. So some of the best performers may be actually the laggards.
Correct.
And now how do you choose? Because you don't have the professional expertise to choose the winners versus the not so, the schemes which are not doing so well. So I need some help, and that's when people started going and consulting people. Whether it was online or face-to-face is a separate matter. Also, women in workforce have grown substantially in the last 5-7 years, and they are more independent women now.
Correct.
So, for example, they may still come from a family where the husband is also working, they are staying with the in-laws, but they would want to take decisions on their own also. So, they want to learn finance. So, that's the second big change that is happening. Third, as an industry, we have done a huge number of investor education programs for women, specifically women oriented. In fact, there are some people who do only white collar women oriented programs. Yeah, and it doesn't make a difference whether you're an entry level or you're a senior executive, but they do that. I think all these things are changing. And the fourth, which I would like to say, is many distributors or advisors now actually sit with the male member of the family only if the spouse is sitting with them. I think that is a bigger change that I see. Because they say, listen, I will discuss it with you, I have no problem, but I would like your spouse also to be listening to the discussion. I think that also has helped in terms of ensuring more women are now participating in the financial decision making process.
Right. One major shift is obviously digitization, and the way digital ecosystem has evolved in India. It's, I think, one of the best and most efficient in the world in such a short time. How has that helped in bridging the divide between, let's say, the urban investor behavior and a rural investor behavior, or simply bridging the gap between tier 1, tier 2, tier 3 city investors, and how do you see that evolving going forward?
So, digital investments is a end story. When you are completing the transaction, you don't have to do a physical paper, right? But initially, you would want to do some kind of a planning exercise. Now, a lot of tech platforms have come up, also do your risk profiling, also advise you based on your risk profiling, and based on that, you need to take your decision. So, there is some level of discussion which happens. It may be happening purely online, and surprisingly, I think I come from the old world school, but there are a lot of people who are completely fine with not meeting a distributor, and actually completing the transaction and going by what the advice came in, which the platform has given. On the other side, there are people who want that face-to-face interaction, but I think coming back to my earlier point, that if your corpus is relatively smaller, you're quite comfortable doing it on your own. But the moment the corpus starts getting a little sizable for your wallet, you want that validation.
Correct.
That am I doing the right thing, because you realize that this game is not as simple as it is. And when the markets are doing well, nobody comes to you. It's during such times, the volatile times, or when the markets are down, that they need validation, because they have taken their best decision and that decision would have gone wrong.
Correct.
Now, who do you validate it with, that your decision went wrong? You can't validate it with a computer.
Correct.
You need a human being, and that's when they start working towards it. So I think both are complementary, but the good news, the transaction part of it has become completely online, including post-sales service, query management. You got bots, chat bots, and the works which is there, which is so important.
Right. Is it right and safe to say that even SIPs as an instrument, the perception has changed in the mind of an investor from only a pure savings enabler tool? Today it is being seen upon as maybe wealth creation tool as well?
So it's now become goal based. Most people are putting SIPs linked to a particular goal, 7-year, 10-year, 15-year. It's not surprising today to see 30-year SIPs being signed up because that's for their retirement, or 40-year SIPs being signed up because it's for their retirement. I think people have understood the power of SIP. The second big change in SIP that we are seeing, it's no more the 3,000, 5,000, 10,000 rupee SIP which is getting signed up. It's actually how much money you require to attain that goal. So we are not, we see many SIPs which are much larger than the 10,000, where people are very happy to invest in it. Also, over a period of time, there's enough anecdotal evidence now that through the volatile times, through COVID, through all the falls, you know, the SIPs have actually done very well because you ended up buying more units. So the discipline in investment has come, and I think that's becoming well understood. So now with 27,000 crores per month, it's a huge number. But what's important is not the 27,000 crores. I think it's 11 crore plus SIPs, which are hitting the bank every month. And this will only continue to grow as more and more people get comfortable with it.
Right. And even this 27,000 or 25,000 crore number, even that is it safe to say that that's just the beginning of the longer term trend?
Oh yes, very, very clear. And you know, there's a lot of questions being asked to me that, oh, if the market crashes, will these SIPs stop? And I say, okay, let's take a worst case scenario. How many of them will stop? 15%, 20%? That's still 22,000 crores, which is not a small amount of money. You're talking about 2.5 lakh crores per year of net inflow into equity market, which is substantial. And if everything, as per everybody, that India is going to be the fastest growing major economy in the world, and I tell people, okay, don't take 6.5, take 6, which is more conservative, you still are going to be the fastest economy in the world in terms of the major economy. Then what stops you from investing more money? Today, you'll be surprised, the investor behavior has changed so much. The day the markets correct 1.5%, you know, people actually wait till 130,
then
check,
they deploy.
And actually that day they deploy money. So on days of big correction, we get more average daily inflow in our funds than on a standard day. So people have become that wise to say that apart from SIP, they actually are trying to buy into the dips in the market.
Correct. No, it has been a very interesting journey and interesting conversation. But Kailash, as we conclude season 2, and obviously everybody is looking forward to season 3, what is your message to an investor who's probably still sitting on the sidelines and trying to time the market or trying to time his entry?
You know, this behavior is going to be the most difficult one to change, because everybody believes that they can sell at the top and buy at the bottom. The honest truth is it can never happen. You can get lucky maybe once or twice, but you are not going to get lucky all the time. And you know, if everyone knew which was the top and everybody knew which was the bottom, nobody would be doing the work or the business that they are doing in. Everybody would be having their fancy bungalows in a seaside resort or an island, you know, and enjoying life. It's tough. So people, those who are still sitting on the sidelines, have to start today. It's not when can I start. If this message goes to you, you should start today. And start regularly. I think that is very, very important. If you believe in the Bharat story, if you believe that India is going to be the next big economy in the world, then you're missing out on the big picture. Finally, let's take into account somebody who had invested just pre-COVID. They saw a 35% correction in COVID
Correct.
in 15 days, right, or 20 days. But then look at the recovery from there.
Correct.
So who lost out? It's the people sitting on the sideline. I think that's where I'm coming from. There's enough anecdotal evidence today, data points today, which show that you actually lose out by sitting out of the market. So more time spent in the market, you make more money rather than trying to time the market. I think we have been talking about this for long, but now you don't need global data to show you this. In the last 10 years, there's enough Indian data to say that this is what has happened.
Right.
And I think that's the message we need to carry to the nook and corner of the country.
Absolutely, Kailash. It has been a very interesting journey and pleasure having you on this show.
Thank you so
and
much.
I look forward to next season of Informed Investing. Thank
Looking
you.
forward to it. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.